What if the silver market isn't just volatile right now, but quietly stressed beneath the surface? What if the recent moves we're seeing aren't random price swings, but signals that something deeper is shifting inside the COMEX vault system? Because today, the inventory data did something that serious silver watchers can't ignore. And if you've been paying attention to how physical supply interacts with paper markets, you already know this story doesn't end quietly. On Silver Shockwave, we don't chase hype. We track structural shifts. And right now, the structure deserves attention. Over the past several sessions, COMEX silver inventories have shown subtle but important changes. Registered silver, the category actually available for delivery, has been fluctuating in a way that suggests tightening availability. Now, to be clear, this isn't the first time we've seen stress in the system. Back in previous cycles, inventory drawdowns preceded major price volatility. The question is whether we're watching the early stages of that again. Here's why this matters. The COMEX operates primarily as a futures exchange. Most contracts are settled in cash, but the credibility of the entire system rests on the assumption that physical metal is there if demanded. When registered inventories drop while open interest remains elevated, it creates a leverage imbalance, more paper claims per ounce. And that ratio is something institutional traders watch very closely. Right now, open interest remains relatively firm while inventories are not expanding aggressively. That divergence doesn't automatically mean a shortage, but it does raise a red flag, especially when you combine it with reports of elevated premiums in overseas markets and steady retail demand in the United States. And then there's the psychology factor. Silver tends to move fast when confidence in supply stability weakens. It's not just about ounces. It's about perception. If traders begin to suspect that physical availability is tightening, volatility increases dramatically. Short positions become riskier. Delivery requests gain more attention, and spreads can widen unexpectedly. What makes this environment different is macro pressure. The dollar has shown periods of instability. Bond yields remain sensitive. Banking system confidence globally has been tested more than once in recent years. Silver doesn't operate in isolation. It reacts to systemic tension. And if inventory stress coincides with macro instability, price acceleration becomes more likely. Now let's talk positioning. Hedge funds and managed money traders have not fully committed to an extreme bullish position yet. That's important. It means we're not looking at overcrowded optimism. In fact, pullbacks have shaken out weak hands recently, which means if a structural catalyst emerges, like delivery strain or inventory headlines, there is room for upside positioning to build. But here's the balanced reality. Inventory fluctuations alone do not confirm a crisis. COMEX warehouses regularly move metal between eligible and registered categories. Large holders can reclassify bars, so we must avoid dramatic conclusions. What we're tracking is stress potential, not guaranteed failure. Still, history shows that silver thrives when physical narratives collide with financial uncertainty. The 2020-2021 period reminded everyone how quickly sentiment can flip. It starts quietly, then headlines accelerate. Then momentum traders pile in. If registered stocks continue declining while demand indicators remain firm, we could see renewed speculation about delivery tightness. And even rumors can move this market. The bigger picture? Silver sits at the intersection of monetary hedge and industrial metal. Green energy demand remains structurally supportive. Solar expansion continues. Industrial usage is not disappearing. That underlying demand floor makes physical availability more important than many realize. So is COMEX running out of silver? Not today, not officially. But are there early signs of tightening conditions that deserve attention? Yes, and markets often move before official confirmations ever arrive. That's why on Silver Shockwave, we monitor the data before the headlines explode. Because by the time mainstream financial media starts asking questions, the move is usually already underway. If inventories stabilize and open interest cools, this concern fades. But if the ratio between paper claims and deliverable ounces widens further, volatility risk increases significantly. And here's the key takeaway. Silver doesn't need a confirmed shortage to rally. It just needs the perception that supply is less comfortable than assumed. The next few inventory reports will matter more than most people think. Stay sharp, stay informed. And remember, in the silver market, structural shifts whisper before they roar.